Well, the market's now thinking 5.5, so 100 basis points higher than we are today, and that is absolutely possible. We were looking at the data a few quarters back thinking, okay, there was some evidence that perhaps things were starting to decelerate, as we saw in other developed markets. And then 3 disappointing inflation numbers in a row has to make you think there's some structural issues here. It's not going to go away with what they've done so far on interest rate hikes. But we've been noticing the comments coming out of the Bank of England have been constantly wanting to try to play down and say, we've done enough. You know, we're going to wait and see. And then the data comes out worse again. So we are now in a situation where, yes, the Bank of England's likely to go again, and perhaps a few more times.
You can see it in the animal spirits when you're out and about in the capital, even outside of London.
Yeah.
People are still spending.
Yes.
Cafes, restaurants are pretty full most of the time. So it's not just in supermarkets here. Something needs to change effectively. Is that just monetary policy catching up, or is it more? I mean, the lag effect can be quite a period of time, and is that starting to bite at some stage?
Yeah, long and variable lags. How long are they? We're certainly still coming off a period of, was it excessive COVID spending? Looking back, it was necessary. Nobody knew how long we would be shut in our houses for. But clearly, record low unemployment and people still having quite a lot of savings means we're all still spending money. As we all know, labor markets are the last thing to deteriorate. So we're going to have to really tighten a bit more on monetary and perhaps even fiscally to get those inflationary pressures under control. And yes, we are still feeling it every time we go to the supermarket or really spend any money. Everything is so much more expensive.
How do you make money out of the UK at the moment then? What do you buy to take advantage of this?
Well, I mean, corporate bonds still look good value. So our investor base is still looking at investment-grade corporate bonds and thinking, okay, actually you are being paid for quite a lot of the risks here. We don't expect a big problem with defaults, given companies have gone into this period of economic slowdown really having done very sensible things, reduced leverage, lengthened the average maturity of their debt, and frankly, they're all saying the same thing. We're putting up prices, we're selling fewer items, but we're maintaining our profit margins. And that will work until it stops working. But for the moment, actually, corporate bonds actually seem to be the place where you would consider adding to exposure, particularly at current yields. Government bonds is a little bit less certain. And that's an area that we're watching carefully because they're selling a lot of them, and the question is, where are the buyers going to come?